and thrilled today to welcome everybody to a webinar on a tax webinar, in essence. And welcome again, welcome back, Marissa Verskin from Crow Soberman.
Thank you.
Marissa is, as people know, a tax expert, succession planning, corporate, charitable giving, really a great resource. And I've posted her contact information in our chat. Um, Following today's presentation, immediately following, like we do every week, you can join us live for Q&A at the eState community. We'll continue the after show for 10, 15 minutes. Um, and welcome, everyone. So, Marissa, there aren't that many ways to avoid tax in Canada on death. We spoke last year about the spousal rollover, which is one of the biggest ones. Um, and now we're going to deal with one of the other major ones, and that's the principal residence exemption. Just a reminder, everyone, if you could turn your videos off. I think some of you have put your video on. If you could just turn that off, that'd be great. And over to you, Marissa.
Thanks so much for having me back. And I'm so excited to be here to talk about the principal residence exemption with you. So, brief agenda. Um, Principal residence exemption, what is it? The effect of death and what happens after death with the principal residence exemption. And then a little discussion about trusts. There were some changes that came into effect after 2016, made things a little bit more complicated than they were previously. Go to the next slide. So the principal residence exemption, as Jordy mentioned, is really a very nice way to shelter some tax. So it's an exemption that's available on a principal residence, and you have to make the designation in your tax return. And if it's available and you're able to claim it, you can actually shelter the entire amount of tax on that one residence. So let's go to the next slide. What does it apply to? So it has to be a housing unit. So it could be a home, it could be a condo, it could be a houseboat. Generally, you're allowed to have land, up to a half hectare of land. Sometimes there are reasons why you might be able to have more. So, for example, maybe it's in a municipality where you can't sever the lot, so you might have a very large swath of land that's included. Ownership of the property is really important. It has to be beneficially owned. So different than title ownership, it actually has to be beneficially owned by the person. And it doesn't matter whether they own it by themselves, they own it with their spouse. In order to claim their exemption, there has to be beneficial ownership. And it has to be ordinarily inhabited by either the person who's owning it, the taxpayer, current or former spouse, or a child. So for example, you could have a condo that you own, and maybe a child lives in that condo and you have your home as well. You would be able to claim the principal residence exemption on that condo. Um, Obviously, you can only have one property. So if in a year you choose the condo, you can't choose the home, but there's that additional flexibility.
Which we're going to get into about the one home. One thing that's important for many of our viewers is this issue of beneficial ownership. We're seeing a lot of people, despite the requirements or the coming requirements for reporting bare trusts. So the fact that a property is owned by a bare trust corporation, for example, that shouldn't have any effect on the principal residence exemption. Is that right?
Exactly right. So it doesn't matter that you have a bare trust corporation, that could be for probate reasons. It's the beneficial ownership that we're looking at here.
Thank goodness, because I've done a lot of those transfers telling them that it's okay. So that's good to know.
Perfect.
Um, so on to the
Residencies.
one PR.
Yes. Residency is also really important. Throughout this, I'm going to assume that everybody is a Canadian resident at all relevant times. If you have people who are coming and going from Canada or people where you're not sure of the residency for particular years, then that adds some complexity, and that's an issue to consider. I've kind of touched on that every year that you have, you can only designate one principal residence. So if you have a home and a cottage and you have the year 2026, you can only designate 2026 to either or, not both. So when you're looking at somebody's return and you're figuring out, now how do I decide which property to claim? you do an analysis, you get an information on what is the fair market value of the property, calculate the adjusted cost base, which is generally what did you pay for it, plus adjustments like major renos and so on. What is your gain? Figure out when did they acquire this property, and divide it by the number of years that they held it. That tells you your gain per year, and you're obviously going to want to pick the highest gain per year. There's some nuances in the calculation about how it's calculated because you get a 1 plus, which really factors in that in a year you could be living in, you're going to move somewhere in a year, and sometimes you can get a little pickup from that calculation as well.
I had a question about could you go could you go for each year and say, okay, I'm going to get a valuation the beginning and the end of each year, and then pick and choose, okay, this year I'm taking the capital gain here for this property, and next year I'm going to do it this one, and then switch back and forth for each year?
So it doesn't really work that way. It really looks at the fair market value at the point of sale. And so you raise a good point, because if you have two properties and you sell one of them, then you're really guessing on the gain per year on the other property that you didn't sell. So you're saying, well, I think I'm going to hold that other property for another few years, so I estimate that my fair value will be this and my gain per year will be this. But because we don't have a crystal ball, often it's more of an art than a science, and it's a
Got it.
best guess.
That's interesting. Okay. On the ACB, just a quick question. Major renos, are there anything else that contributes to stepping up that ACB on a property?
You might be able to claim some legals. So like if you paid land transfer, or if you had to get somebody involved to transfer property, issues like that. But generally it's those major costs and things like you have to be careful that you're splitting out true renos from repairs and maintenance. Like if you slap on a coat of paint, that's probably a repair. It's probably not something that you could capitalize. But if you go and I don't know, redo a kitchen, or you add a level to your home, then that sounds like it's more of a capital improvement. And keeping records is really important. So where you only have one property and you're going to claim your principal residence on the whole one, nobody really cares what the adjusted cost base is because you're sheltering the whole gain anyway.
Right.
It's only really important if you have multiple properties. And in that case, really good record keeping on what those adjustments are is useful to have in case CRA should come in and audit.
Great.
Just on the reporting
Oh, yes.
requirements, for earlier years, there was no need to report it. So people would sell their main home, there would be no reporting. They would just go on, they take the proceeds and usually go and buy their next home. For 2016 and later, there's a form that's required to be filed. There are actually two types of forms. The one is where there's a disposition on death, and the other one is where it's during somebody's lifetime. Very similar information. But it's really important that that form gets filed. If it's not filed, you're considered to have a taxable gain, which nobody wants. And if it's late filed, there are penalties that go up to $8,000. You can't get this penalty waived. We have tried. If you apply under the voluntary disclosure program, I've seen that one be rejected on the basis that this is a voluntary election that you can make. And we've not had good success with getting rid of that penalty. So it really does seem that maybe somebody will be luckier than I am, but from what I've seen, if you file that form late and you want to claim the principal residence exemption, you're looking at a penalty of up to $8,000.
And we have some real estate, I'm sure a bunch of real estate lawyers who do real estate. I guess that's something that they should, when they're acting on a sale, maybe a good idea to remind the clients to let their accountant know, even if it's a principal residence.
100%. It's always nice to give friendly reminders because clients will really appreciate that they filed this form that was so important to them.
There we go. We add to the real estate people too. This is
Plus one.
Mhm.
Some other considerations. So as life changes, sometimes the use of a property changes. So it could be that somebody has a home that they're using personally, and they decide, you know what, we're going to move to a different property. We're going to hang on to this original home, and we're going to start renting it out. When you go from a personal property to an income-producing property, for tax purposes, you have a deemed disposition, and that is taxable. So it has to be reported. If you're claiming a principal residence exemption, you might not be so fussed about it because you're not paying any tax. But there is this election that's available. And what the election does is you file it with your return. And it basically says that this thing happens, but you don't actually have to pay the tax. until you're going to sell the property. So it's very useful to have, particularly in a case where you have multiple properties, and you really would have a tax bill on that. There's some tips and traps with that. You can't claim capital cost allowance when you've made that election. Capital cost allowance is like tax depreciation that you would normally be able to claim to shelter some rental income. And so sometimes there's a question of, do you want to file this election or not? So that would be fact specific. What's really useful about this election is, should you make it, and let's say you move to another property for some reason, you generally get a 4-year window where, even though the property is an income producing property where you have this election, for 4 years you could designate that property as your principal residence. So if somebody moves away, they rent it out for 3 years, and then they come back and they continue to live in that property. Again, assuming they're not designating another property as the principal residence, they wouldn't have any leakage, so they'd still be able to fully shelter that gain on ultimate disposition. Also important to file on time.
Yes.
Incidental rental. So oftentimes people will rent out a room in their home, or they'll rent out a basement. And so we often get the question of, does this mean I can't claim my principal residence? So CRA's view on this is generally that so long as it's incidental, so long as it's not the main reason that you're holding this property, you're generally okay. Don't claim capital cost allowance, that tax depreciation, that'll throw you offside and stop you from claiming your principal residence exemption. And then it's really a question of fact of, was this incidental or was this the main thing? So if you're renting out your basement, maybe you're okay. If you are living in the basement and you're renting out your main home, maybe you're not okay. So it's very much a fact specific. It also depends on the structure. So I've had clients where they've had a triplex and they've lived in one of the units and rented out the others. That would not qualify because those are separate homes. So you would only get the principal residence exemption on the unit that was yours, because those are now separate properties.
What about so this is kind of renting it for use, somebody to live there. What about people who use part of their home for their business? I have clients who do that. What should I be telling them about that?
So it depends. It depends. So if you're now running a business and this is a business property, this is not a principal residence. Maybe it's a portion, maybe it's incidental. It would really come down to the facts and what you're doing. Like if you're warehousing goods and you're living in one room and the rest of your home is holding the goods and you're running an operation, maybe that's not such a good fact pattern.
Right.
But if you're sitting at a desk and you're working from home, I wouldn't expect that to mess with your principal residence exemption.
Right.
Jordy, you'd asked the question about what if mom lives in a house and she moves to a care facility? So what happens there? It's another question of, it depends. So if she leaves her home and it's vacant, she might not ordinarily reside there anymore. So if she's, for example, disabled and now no longer able to get into the property, not a good fact. If it's temporary, so maybe she went into rehab, that's a good fact because she's getting better. She's going to come back. She ordinarily resides there. She just needs some time to get better. So we're looking at whether this is a temporary move or whether this is a permanent move. If it's rented out, then we're back to, was there a change in use? And you could make that 45-2 election. And then you would have a grace period effectively of 4 years to figure it out.
And that applies, many of our clients, we act for attorneys for property. The person moves out to a nursing home. Now they have a responsibility to maintain this home or do whatever they need to do. That's an issue for them to get advice on and figure out what's best, right, from a tax point of view.
Sure. And then you're looking at what can you do with those expenses. So if you've now decided that this is a rental property and you're not actively trying to rent it out, nobody's going to live there, you get access to some deductions as well because you're allowed to claim against your rental income.
Right.
Other occupants like caregivers shouldn't change things. So if you're sharing your home with family members, that's certainly not an issue. If you have a caregiver that's staying with you, again, if it's one caregiver who's got a room in the basement and they're effectively renting from you, I would consider that incidental rental. If you start to provide rental facilities to your caregiver and all of their friends, maybe you have a rental operation. So again, fact specific, but we're focusing on whether or not it's incidental. Once somebody passes, so on death, they're deemed to dispose of everything that they have at fair market value, and that includes the value of their home. And it's at that point that the individual can generally see if they can claim the principal residence exemption on that death. Again, there's a form that has to be filed in the return. Once the property, so on death, it moves from the individual to the individual's estate. The estate generally can't claim the principal residence exemption. So usually there's a holding period. So again, we're going to pick on mom. So mom dies, the property goes into the estate, and everybody's figuring out, what do we do with this property? Is it going to the beneficiaries? Maybe we're going to sell it. If they decide to sell, there's a time delay between when she died and when the property is sold. And so you could have a gain or a loss. Gains are generally taxable. Losses may be claimable, but if somebody's been living there and it's a personal use property, that loss could be denied. So again, it really depends on what was the intention, what happened with the property. Another option is, let's say the kid decides that they want to keep that property. The estate can, and they're Canadian, always assuming Canadian, the Canadian estate can generally roll out that home to the beneficiary. And then the beneficiary would inherit the cost base from the estate, which is effectively the fair market value of the property on mom's death. So that gives them a really nice bump in value that's tax-free, because mom's sheltered presumably with her principal residence exemption. And then the beneficiary would only pay tax at the time that they sell the property, or the time that they die, or the last of them when their spouse dies. Going back to the spousal rollover conversation.
Right. So we often have been taught, you want the lowest value for probate tax purposes, because you're paying a 1.5% on the value of that. If you set that, if it's very low, and then you sell it, 6 months later for a number that's much higher, there's probably a disconnect between your affidavit on probate and your filing CRA. I mean, does CRA and the Ministry of Ontario's Finance, do they talk about that? Have you ever seen that as an issue?
I don't know the inner workings of CRA and how they find these things, but it's definitely a disconnect. And I think it's an important point, because you don't want to get a probate value that's too low, because you really want to shelter the right value with your principal residence exemption. Because if you sell, maybe you saved 1.5% on probate, but now you're going to face very real capital gains tax on that increment. So it is important to get that value right, and have the documents marry up so that you've got support for those values.
Right. So that's assuming, you've got a will that says, either sell all my assets, including the home, and distribute the residue, or, give my home to, John, where you could transfer at the cost base at date of death. That's fine. Now we're going to talk about, what about where you want to maintain that home post death in a trust, for example, and let people live there, and the relatively new rules about those kinds of issues, right?
Yes. So it is possible to hold a principal residence in a trust, but under the new rules, only certain types of trusts can claim the principal residence exemption. So the list is up on the screen, and we'll talk about each one of these briefly. So I wanted to start off with a spousal trust. So a spousal trust, it could be set up either on the death of the first spouse, or it could be set up inter vivos. But what's really important about a spousal trust is that nobody other than that spouse can use the assets. They can't get income from them. They can't enjoy the assets during the spouse's lifetime. It all belongs to the spouse. And on death, it goes to whoever is listed in the spousal trust. So the capital beneficiaries.
And if you want more information about what qualifies as a spousal trust, you can check out Marissa's previous webinar that we did on spousal trust QSTs and those kinds of things.
Sounds good. And all of these comments, I didn't mention earlier, but all of the disclaimer that all these comments are general and we're not giving tax advice because it's too, the rules are too fact specific. So with a spousal trust, there could be a concern if you have other occupants. So let's say, good example is a cottage property, and the kids come up and they visit mom, or they stay for a few weekends. Um, it's possible that because now somebody else has enjoyed access to this property, maybe it's not a spousal trust. So that could be a concern. Um, in the case where you have a main home and mom just lives there and maybe the kids come around for coffee or dinner or whatever, it seems with that would seem to be less of an issue that it's really mom who's clearly got the only access to this home. She's the one who has the keys. Um, if in the situation where you have a cottage property and the kids are using the property, let's say the spousal trust sells, and let's say it doesn't, for whatever reason, let's say that it doesn't upset the classification as a spousal trust, so we can claim the principal residence exemption. What it does is anybody who ordinarily resided in that property, if you designate, say, 2025 as you're going to use your principal residence exemption for that year, you've now designated for each of those beneficiaries who've used the home 2025 for the cottage property, which means when they sell their properties down the road, if they own their own principal residences, they cannot claim the 2025 year. So it's important to think about the side effect of if you put in a property that has shared use, such as a cottage, into a trust, what happens to those other beneficiaries? Because it might actually be better just to pay the tax, not claim the principal residence exemption, and preserve everybody else's. Authority to sell. So the authority is really based on whatever the terms of the trust are. And it's important that the proceeds of the sale, again, back to it has to be used by the spouse. No one else can get those proceeds. In terms of expenses, good trust hygiene would be just have the trust pay the expenses. It's simple, it's cleaner. There are no concerns that somebody inadvertently made a contribution to the trust when they shouldn't. There definitely are times where someone else could make those payments and it wouldn't be a problem. But I would say a good rule of thumb is set it up so that the trust is paying its own and then get specific advice if someone else is going to pay those expenses.
Maybe we could just talk about the one, let's say we have a qualifying spouse, the property is held by a qualifying spousal trust, but we're saying, listen, any expenses for the home are paid by the spouse. Would that disqualify? A, is there a rule, or is that kind of fact specific too?
Probably not. I mean, that spouse is probably a contributor, but they're really paying something for their own benefit. No one else is benefiting. Um, and there's no income that's earned. So I wouldn't think that that would be an issue. But again, if there's ever any doubt, it's just cleaner for it to be paid by the trust. But I mean, in that situation, I don't see that there would be a problem.
Right. And just for those of us who draft home trusts, and you'll know if you use eState looks at the home trust that you're preparing, and it warns you if it sees that it wouldn't qualify as a principal residence exemption to maintain the principal residence exemption. One of the key factors there that is if it's sold, the proceeds don't go somewhere else; they stay in the spousal trust, and that's really crucial during the lifetime of the spouse. Um, Maybe we'll quickly talk about the disability trust, the two different there.
So there are two disability trusts that are here. Quite similar in that only the disabled beneficiary can receive benefits during their lifetime. So same sorts of issues as we discussed with the spousal trust. I think it's just useful to know that this is available. Um, let's go to the
Sure.
next one, and
Yeah.
we're running sort of to the end.
Yeah,
Uh,
yeah, we're
don't want
good.
to run out of time. Disability trust. So again, this is somebody who qualifies for the disability benefit, and the person can there are some. So the qualified disability trust, there's actually an election that gets filed. The disability trust that's not a qualified disability trust is a little bit broader, but you're limited in who can be the settler. But when you look at the list, it's generally the people who probably would be the settler
Right.
anyway.
Right.
And it's the same thing as the spousal trust. Only that person is supposed to receive the benefit.
What do you do when I see this occasionally? You want the client wants their disabled child to be able to stay in a condo, but the other sibling is going to live with them. Um,
So
does that raise an issue in your mind? Do you need to get some specific advice on that?
yeah, so that would be an issue of whether you really do have a disability trust. Because if someone else is getting the benefit of that asset, then maybe it doesn't qualify. Maybe it's possible to take the position that that child actually needs the sibling to live there because they can't live there by themselves.
Right,
And reason would say, that should really qualify, but you'd have to make sure that it actually does because reason and the rules don't necessarily align. You really do have to fit within the rules.
right. And sometimes maybe it's better just name the disabled child as the beneficiary, but knowing that the sibling is going to move in as a caregiver, companion kind of thing, overseer, um,
Right.
which has its own issues. So. Um, just before, we'll just take one little second here. We've got about 5 minutes left. Just to remind people, we're going to continue with if you've got specific questions for Marissa or generally about this topic, we'll see you on the live stream in the community, and it's in the chat, in our chat here, and you can get the links. And lastly, and we're right on time, Marissa, we were worried but we're right on time. Talk about this other,
The minor's
trust.
trust.
Yeah, that to maintain the principal residence exemption.
So this is an interesting one as well. There are two types of minors trust. There's an inter vivos trust. So inter vivos means parents set the trust up for the kid while they were alive. And in that case, it only qualifies as this minors trust if both parents have passed. Otherwise, if this trust is set up on the death of a parent, so by will for the kid, then it would qualify here. Um, and this trust only qualifies so long as a beneficiary is basically a minor, so they're under 18, which means that if you have a kid, if you maybe you have a few siblings and maybe you leave it for all of your children, let's say you have 4 kids, the youngest is still a minor, and they sell, so long as the littlest is part of the trust, you can claim the principal residence exemption. But it does come with the same stickiness that for each of those other kids, if they ordinarily resided in this home, they then cannot use that year to shelter any other property. So let's say one of the kids goes to university and they purchased a property there, but they come back in the summertime and they live in the family home. They wouldn't be able to, if you use the exemption in the trust on the main property, they couldn't then use it on their residence. So it's important to look at those side effects. The other thing that's interesting is that as soon as the kid hits 18, this trust no longer qualifies. So you're probably watching to see if you want to claim the principal residence exemption, if you're either going to sell before the kid reaches the age of majority, or if not, what's going to happen to that property? Is it going to be rolled out to the kids? Is it going to be rolled out to one kid? And what's going to happen?
Yeah. Um, so we've covered, a lot, and these rules have gotten more complex. Certainly about principal residence trusts, especially. But it is the one, that's most of our clients' biggest asset is this, and it's the one that's tax free. So want to make sure that we maintain that when we can. Before I thank Marissa, I want to mention next week a special webinar involving the Law Society. Those who know, we have our contingency planning requirement that's in place already, but we have to file our members annual report in March. And so if you haven't maybe finalized everything quite yet, we've got our contingency planning webinar next Thursday with Amy Sutherland and Kelly Guerra from the Law Society, who will make sure that we're on side of the Law Society for those contingency plans. So if you might want to join us for that one. I want to thank, we had I don't know if this is a record, but the large number of people who joined us. Thank you. Thursdays here at Eaststate Academy, you're welcome to join it. It's free for everyone. We hope you find it useful. And Marissa, thank you so much for joining us again. And for those who are interested, please join us over at the Eaststate community, and we'll continue our discussion there.
My
Thanks,
pleasure. Thanks so
everybody.
much for having me.
Thanks, Marissa. Thanks, everybody.